Well, you've primarily focused a lot on equity all your life. Right now, we keep hearing other people saying that perhaps some of the more interesting investment options are actually not equity immediately. Could be oil futures, oil might go up, could be gold is going to continue to do well with monetary debasement. Do you like any of those other areas or commodities, or do you think equity is the place to be?
Well, the whole idea of investment is to lay out money to get more money back later on, right? And if you buy a farm, or you buy an apartment house, or you buy into a business, either one you own directly or one you own a piece of through stocks, you are buying into an asset that you expect to produce something later on. Now, if I buy a farm like I did 25 years ago in Nebraska, I bought a farm, 400 acres. I paid close to $700 an acre for it, and I looked to see how much it would get an estimate of how much corn it would produce per acre, how many soybeans, what I'd have to pay the tenant farmer, what the taxes would be, and I made an estimate of the income that I would receive from that farm. I didn't go out and get a quote on it, you know. I didn't turn on the farm channel, you know, every day to see whether it was raining or something and whether it was good for my farm. Instead, I looked at the farm itself as to what it would produce. That's what I do in terms of stocks. Now, there are other kinds of assets that don't produce anything, but you count on them becoming more attractive to people next year or the year after. You're looking to the price change rather than the output of the investment. That's a whole different game. I mean, if you buy, we'll say, art as an investment, and you pay $20 million for some painting, you know, you don't look for the painting to produce anything. You just, if you're looking at it as an investment, you just hope somebody else will like that painting even more a year from now or 2 years from now. You're betting on the price of the asset rather than the productivity of the asset. I like things where I look at the productivity of the asset. You know, I've used this example before, but if you take all of the gold in the world that's ever been produced, it comes to about 165,000 metric tons. Some people get excited just talking about that sort of thing. But if you put that all together in a cube, you would have a cube that's about 67 feet on a side. So we can take something maybe about the length of this hall here and have a cube like that, and that would be all the gold in the world. That gold at present prices is selling for $7 trillion. So that cube is a $7 trillion asset. Now, all of the stock market in the United States, I don't know the exact figure now, might be 20 trillion. So would you rather have a third of all of the businesses that exist in the United States, or would you rather have that cube to look at? That cube, if you take all of the farmland in the United States, there's about 1 billion acres of farmland. That's a little over 1.5 million square miles, about half of the continental United States. If you take all of the farmland in the United States, that 1 billion acres, you add in 7 Exxon Mobils, and then leave yourself $1 trillion for kind of walking around incidentals, that would be the value of that cube. Now, would I rather have that cube, 67 feet on each side of gold, or would I rather have all the farmland in the United States plus 7 Exxon Mobils plus $1 trillion to stick in my pocket? I think that's kind of an easy decision. But people like gold. When they get afraid of money, terrified of money, they run to gold, and then they hope somebody will pay more for it next year, because it isn't going to produce anything. That cube is just going to sit there and stare at you, you know. And you can go, if you own it, you can go and you can fondle it, you know, and you can sit on top of it and do whatever makes you feel good. But it isn't going to deliver anything to you. Did I indicate a preference there?